Hey everyone, this is Logan Hertz with Hazeltine LLC. We are joined once again by the man, the myth, the legend, D'Andre Clayton, founder of Clayton Financial Solutions. He's also an infinite banking agent like myself. But today we're going to talk about something else that he specializes in, which is the first lien HELOC solution, also sometimes coupled with something known as velocity banking. Um, and so, DeAndre, you want to just jump right into it and give us an overview of what is this first lien HELOC velocity banking thing, and why would anyone want to do it?
Yeah, so the first lien HELOC. Now, usually you kind of have to start off with what a traditional HELOC is, because it was so funny when I first had a podcast on this particular subject. There was a bunch of real estate investors who had never heard of a HELOC, which I was shocked by, right? So I don't want to assume that people know what a home equity line of credit is.
Yeah, please
So
explain. Yeah.
so the easy part of understanding how a home equity line of credit works is it's basically a liquid loan that's against the house and it's revolving, right? If you want to be the most simple way about it. And typically that loan is a simple interest loan. And sometimes it'll be structured as a interest only, which is kind of the preferred way to use it, so that a principal isn't required. But when you start using things like velocity banking, the idea is that you start to understand, okay, well, this is how banking works. Well, could I transfer the things that banking does? For instance, usually banking is about lending. you know, Lending and storing is sort of speak the language of banking. So there's a debtor, there's a lender. When I think of banking, I think that what we've done naturally, especially in this nation, is we've gotten into a habit where we don't follow the principles of money because we're used to the convenience of a bank, right? And so what I mean by that is money is really only supposed to have three purposes. And I say this every single consult. You're either protecting something, you're growing it, or you're paying off debt. Anytime money doesn't serve one of those functions, inflation wins. There's no way around it, right? And that's because currency is meant to move, right? So the velocity banking concept is about making sure that every dollar moves somewhere. If it's going to be here, it's paying off debt. If it's going to be here, it's growing. If it's going to be here, it's protecting something, right? That's kind of the overall idea of what's going on with velocity banking. Now, of course, they have some different versions of it where maybe you use a second position until you can qualify for a first position, so on and so forth. But the benefit of using a HELOC is it really is a perfect consolidation tool. Now, I always tell people, when it comes to consolidating, if you've ever used like a debt consolidation loan, the reason why they exist is because we don't understand interest. That's the only reason why a debt consolidation loan exists. Now, you notice that taxes are not consolidated that much because we understand them for the most part. So, for most of us, if we think about, for instance, hey, I want to go get a Snickers bar, you don't think about paying sales tax for the rest of your life on that one Snickers bar. That's sales tax. That's not property tax. So you can differentiate the two very well when it comes to that. Interest, however, because there's so much media surrounding one aspect of interest, we lose the concept of how interest is fully configured, so to speak. So we start to think that interest rate is interest instead of realizing that interest rate is a component of how interest is calculated, right? And so, because we do that, the first thing you'll ever hear somebody say when it comes to the velocity banking concept is, well, how can you save money if the interest rate is higher than that happens all the time, and it doesn't matter how smart the person is. what it reveals is that they just don't understand interest. And many high level professionals have no idea of how interest works, right? So
Yep,
here's the,
I just have to
yeah,
say, I dealt with like people in the financial
oh, yeah,
sector, highly experienced CPAs, who supposedly do this for a living. And not only do they not get it, they can't get it.
they
No
can't.
matter how many times you explain it to them, they just can't get it. It's like, but no, but this rate is higher than that one. But no, it works the same. And I've had these frustrating
Yeah,
conversations.
absolutely. Absolutely. It is frustrating because you're like, hold on, you should definitely be able to grasp this. But
Right, right. And
it's,
sometimes, so we're talking about, I'm jumping ahead a little bit, but we talk about simple interest,
uh-huh.
which is what a HELOC, a home equity line of credit charges, versus amortized interest, which is what a mortgage charges. Sometimes I find it helps a little bit if you say, okay, simple versus compound interest, right?
Hmm.
If you're earning compound interest, that's a good thing. If you're paying compound interest,
Right.
wouldn't you
Sure.
rather pay simple interest?
You would
And
rather
does
pay.
compound interest grow more than simple interest, even if the rate is lower, right?
Very, very good. In fact, when I go into the consults, one of my mottos that I've come up with is as simple as pie, right? So basically, anytime you pay debt, you want it to be in a simple interest environment, and pie is just that placement is everything. So we'll show that placement is everything a little bit later when we get into the calculations, but the idea of interest is really broken down into four components. It's not just interest rate as we speak about. So normally when I'm doing an appointment, one of the funniest things that happens is I ask them, if I told you the interest rate to this thing was 45%, what is your immediate reaction? And then people are like, they're freaking out, right? And then I said, well, what if the balance is zero? How much interest do you owe? And they actually think about it for a second sometimes, and they're like, zero. And right away they realize, oh my goodness, I'm scared of interest as interest rate as though it is a independent variable and not a codependent variable, right? And so I said, okay, well, now we know that balance is number one. Balance is number one. That's the most important component to how interest works. It can't charge on anything if balance isn't there, right? Now, the next important component of how interest works is always going to be time. And a lot of people don't get this, but then they start realizing, oh, yeah, you got a point there. Time is measured in two different places. It's measured in tenure and it's also measured in frequency of the charge, right? So you may think that you have a 30-year mortgage. I'm sorry to tell you this, you have a 360-month mortgage. There's a difference. There's a difference on how frequently you're being charged. Same thing, but when you take out a car loan, you are not just dealing with a flat 3%. You're not just dealing with a flat 4% because it's amortized. You're dealing with amortized loans. You're dealing with loans that have tenures to them, right? So the proof that time is so important is if you walked into a bank today and you said, hey, I need to get $20,000. I need a loan for 20,000, and I'm going to pay that 20,000 back by the end of the month. Would the bank loan you 20,000? What do you think, Logan? You think a bank will loan a person 20,000 for a month?
Not unless they're giving you a hefty prepayment penalty.
Right, right. And the reason why prepayment penalties exist is what? They know that interest needs time. So they put that on there that if you pay it too early, they don't get the perceived amount of interest that they really wanted to get. So they need to penalize you for that, right? So now time is number two. Now, what's number three? Now, you've already mentioned number three, which is the class of interest, right? So what do we talk about when we mention in class? Is it simple? Is it amortized? Or is it compound? Now, a lot of people are familiar with dealing with the pains of compound. a lot because they have credit cards, right? So they deal with this situation where they're paying their credit cards, and then all of a sudden on the 28th, they look and they're like, man, they charged me 200 and something bucks. Well, the reason why that happens is because they're charging you interest based on what happened last month, and they're adding interest on top of that. See, compound allows you to charge interest on interest, right? Whereas simple interest, it allows you to not have to deal with compound at least for a tenure, because simple interest can become compound interest. We're aware of that with infinite banking, for instance. If you have a policy and you don't pay the loan for 12 months, well, then of course they're going to stack the interest on top of it. But you had a whole year to not let it compound, right? Now, the other aspect is amortized. And this is the reason why people fall so short on this aspect of interest rate and why it's important. Amortized interest oftentimes has a schedule that is laid out that's maybe about 80-20 for the average person, where 80% goes towards the interest and then 20% goes towards the principal of the loan. And it does this for maybe about 13 years. Then at 13, then it becomes a 50-50 split. Now, why is that such a big difference to simple interest? Well, if you're comparing what a HELOC does, a HELOC is a priority principal loan. Even though it's an interest only, that just means interest is the only thing required to keep it open. But it's a priority principal loan because whenever any payment comes to it, it goes directly and wholly towards principal. And then the interest is calculated over the course of the 31 days and created afterwards. I like to use the analogy of how the differences of how a mortgage and how a HELOC works in interest is very similar to how a W-2 worker is taxed and how a business owner is taxed, right? So a W-2 worker is taxed on the gross, right? So it's already coming out, it's already scheduled. That is what's going to happen. Well, how do we know that a mortgage is similar to being a W-2 worker from a tax to interest kind of concept? Is you can look at the truth in lending page and see exactly how much you're going to pay. The second page of the documents tells you this is what you're going to pay on this loan. This is the total interest, right? Now, when you talk about a HELOC, however, a HELOC doesn't really have a set payment. A first position HELOC doesn't really have a set payment that's designed technically, because it doesn't know how much money is coming in it every single day throughout that 31 days of the month, right? So while the interest rate may be higher on the HELOC, where the difference is there's a lot of fluctuation on the principal. So if the client is, making 10 grand a month or 8 grand a month, that 8 grand flows through the HELOC and the velocity banking concept, right? And while that 8 grand is there, it's pushing down the calculation on the interest per day. So now at the end of the month, you're not actually receiving a flat interest rate fee like you would on a mortgage, right? Because the mortgage, you're paying it one time per month. The HELOC, income can come in as much as it wants to throughout the full 31 days. Therefore, you'll never see the flat interest rate across the board in a given month, right? If you're following the velocity banking concept, and I want to make sure this is clear. If you are not following the velocity banking concept, there is no reason to get a first position HELOC. Let's go ahead and just get that out the way. If you are a person whose mindset is, I want to know how much my payment is, and you stick to wanting to be told what your exact payment is, this isn't for you, and you will struggle. One, you're going to spend a lot more money in the mortgage. That's a given. You're definitely going to spend a lot more money in the mortgage, especially if you're not responsible. And then Two, on the HELOC, if you don't make your mind over to say, hold on, I want my money doing something at all times, you won't grasp the HELOC. So for a person who likes this concept, the idea is that they want their money at least paying off debt at all times. And they want access to the money that they paid the debt off with, right? Now, that's a big deal because, we sit with people all the time who have a decent degree of debt and actually have the capital to take care of the debt. But the reason why they can't bring themselves to make that payment to clear it is because the liquidity is gone from all the money that they used, right? So the first position HELOC solves those problems, and then it even creates wonderful circumstances around other things as far as if you got in a pinch, right? So if you lost your job for some time, well, what happens in the HELOC? Well, it can carry you over, right? It can pay the interest payment and your expenses because your equity now is your savings account, right? So you can increase your equity very quickly, and you can use it to survive off of. So the HELOC now becomes kind of reciprocative, in a way that now I'm gonna say something kind of geeky. I'm gonna say something kind of geeky, right? So in biology, there's two mutual relationships, or there's more than two, but the two we'll talk about, one of them is a parasitic relationship, and the other one is a symbiotic relationship that we'll talk about. So, how do you know that a mortgage is a parasitic relationship? Be told that they're making layoffs today. What's the first thing that comes to your mind? How am I going to pay my mortgage? So that means that you sort of live for it because it came before your kids, it came before your family, it came for everything because you're like, if the house isn't paid for, then oh gosh, this whole ship falls apart, right? And oftentimes, what I've found in consults when I talk about this particular aspect of the HELOC versus the mortgage is that a person would be willing to be paid less for the next job too, just to be able to take care of the mortgage note. So they might make 100K and be willing to take 80K right now because they're in fight or flight. And in that situation, technically what you said is that your house is worth more than you because you're willing to take less money than you have been willing to take in the past, right? Um, and so the HELOC doesn't put you in that situation. If you're in the first position HELOC and you're sitting on $300,000 of equity or $100,000 of equity, $200,000 of equity, and you're like, all right, I know I'm out of work and I need to find work soon, are you going to be as desperate in that next interview, knowing that you have access to $200,000 or $300,000? Probably not, right? Uh, and it's funny because I remember me and you having this conversation about nobody gives you something when you need it. They give it to you when you've proven yourself, so to speak. And and that's so true. So normally, even in the job market, if you're going back to the workforce and you're applying, no interviewer wants to hear how much you need the job. None of them. They only want to hear one thing. How great are you to fill this role because they care about their needs. That's the reason why they're hiring. So now if you come to them and you're at flat zero and you're terrified because the mortgage, you're going to have to board up the house soon. Well, you come off differently in that situation. You come off kind of desperate. But when you're in a house and you're like, hey man, I got $300,000 to spend and I can carry myself over until the next job, you inherently mentally are more prepared for the appointment because you're not going to come off like, oh my gosh, I need you so bad. No, you're going to come off like a person with $300,000. you know? so so those are some of the aspects of why the first lien HELOC typically is a really, really good decision for people. And I think once they see math and anything else and kind of consider where they are at in life, especially if they want to pay their home off before retirement, um, they'll see that there's a much better strategy to doing that.
Yep, yep. There's so many different ways we could do it. So yeah, I don't really have any comments on what you said. You laid it out pretty well. Do you want to move on to the next phase, Mr. Clayton?
Sure. Sure. He's like, all right, cool, cool, cool.
I mean, I do have some questions, but I know they're going to be answered. So
Okay, wonderful,
if you
wonderful.
don't answer them, I'll come back to all the annoying questions.
Got you. Now, I'm gonna just show you an example of some of the average cases that I run across. This is a client who I met actually a couple weeks ago. Had the home for 8 years, and let me make sure I'm zoomed in good enough. Can you see it pretty well on your
Yep,
screen?
yep, I
Okay.
can. Yes.
All right. So when we looked at this situation, what is inherent is understanding that the HELOC matches you at where you're at in life. And what I mean by that is the mortgage doesn't care how much money you make, which is
Yeah.
interesting. You could be a millionaire. Your mortgage does not actually care. It has its terms and it's going to charge based on those terms. The HELOC, however, when you get a bonus or anything like that, and that flows into your account, principal dropping by 20,000 in 1 month, that kind of stuff, if you have a really good corporate job, you start to realize, man, this is way smarter than a mortgage, right? so, so here's the example, right? Currently, she has 222,000 left on the home. 8 years ago, when she had she refied at 270 and at 4%, right? Now, with this being said, now we have our tax layout, $1,200 on the homeowner's insurance, 2,130 on the taxes, but the net income is 7,200 and the monthly expenses is $3,078. Right now, you may say, "Well, hold on, how in the world is she at $3,078? That's not possible for the average family, right?" Well, once again, remember the HELOC is a replacement loan. So, what do I mean by that? Well, when we run these calculations, your mortgage payment doesn't matter anymore because it's been replaced. If you've done a debt consolidation loan, you don't pay your minimum dues to the credit card anymore. It's the same thing inside of the HELOC, right?
Yeah. So when I do, one of the things I do with my clients is a cash flow optimization exercise.
Yeah.
Um, and this is one of the things we look at. It's like, hey, look at your cash flow today.
Mm-hmm.
Imagine without changing anything, we just dropped your mortgage payment. What would that do for your cash flow?
Man, it's nice.
Yeah. And we didn't change anything. We did not change anything. You're not
Yeah.
making money. You're not spending less. It's just
Yep.
drop the mortgage.
Yep.
Wouldn't it be kind of cool?
Yeah. 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 And
So these are some of the things I do when we go through this. So I put my clients in the best possible cash flow situation. And one of the things I constantly harp on is when you work with me, I give you immediate concrete results. It's
yep.
not park your money in this vehicle and hope for some kind of rate of return. And 5 years from now, we'll revisit and see if it actually works. But we
Mm-hmm.
won't know until then if it works. Like, no, I'm putting money in your pocket day one.
Now. Now.
After working with me, you now have $300 a month of extra cash flow for all the stuff
Now.
you did,
Yep.
right? That's concrete, that's immediate. Even if you do nothing else, I improved your situation. We took on no market risk. We did nothing other than
Yep.
just optimize what you're already doing, right?
Absolutely. Absolutely. And it gives you options. So I'm not a market risk person at all.
Mhm.
But for some, they are sort of market risk people. And I will say this about the HELOC method is the higher your balance is on the home, and the greater your income is, because your income and your mortgage should be commensurate. You should be making at least 3 times more the mortgage payment. If you are not, then whoever sold you the mortgage did you a disservice and didn't qualify you appropriately, right? They were just looking for the sale. So I'll make sure I say that. But for the average person, if they are following that barometer, this works. This works, right? Um, and so what ends up happening is they end up having more money for other things. They end up having more money for disability insurance. They end up having more money for life insurance policies. They even end up having more money for lump sums and dropping money into a fixed index annuity or something like that, where they don't have to deal with reverse dollar cost averaging, eating up every account that they could possibly have because they're having to chase after the bunny with the market, right? So I love this as a setup for most people. And I also use it with estate planning because I want people to protect the property as well and make sure that it continues in the family. So I want to show you something here. Now, when we look at this young lady here, now, oh, we forgot to mention 4% interest rate on the mortgage, 7.5 on the HELOC, and we're dealing with principal loan rate of 222 because that's where she's at. This is still based on the 222, but it's showing the 270 that was borrowed 8 years ago, right? So that's how we get accurate numbers because she's further along in her amortization schedule. All right. So let's take a look at what the client had. Well, if we're looking at this comparison loan, which is the mortgage, she's on track for $406,425.04 being due on this $270,000, right? 22 years that she'll have to pay it. And you'll notice the interest paid is $136,425.04. Now, the important numbers to think about, because, and I think I speak for Logan as well, stop thinking about what your payment is. That's how they get you. Think about what is the total cost. That's important, right? And
Total
so
cost of ownership.
for her, the total cost of ownership was 50.53%, right? That was the total cost of the interest, right? Now, if we transfer over to this side, we're looking at 5.83 years. Who wouldn't want to pay their house off in that amount of time, right? That they have 22 years left on. But how much interest is paid on it? $53,086. The total interest is 23.91%, right? Now, the average interest rate used for the example is 7.5%. So you'd have to say, hold on, whoa, 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 whoa. If it's 7.5%, how in the world is the total of the loan 23.91%? The fluctuation. It wasn't charging a flush 7.5% on an even number that it started off with and ended with in a month. It charged it on the difference. Like a business owner is taxed on the net, a person who is inside of a HELOC is the interest is paid on the net of the principal payments that were made throughout the month, right? So it creates a synergy where you're paying significantly less interest. So, hey, 7.5% interest. Well, we can look 5.83 years. We're looking here. So that equates to 4.1% a year. A year. Every year. That's incredible, right? This is the benefit of simple interest in a revolving account where your money is working at all times. So now when you see the effective interest rate, and I love that they added this little spot here because this helps people to see if we stretch the loan for 30 years, well, what would it be, right? This is saying the interest rate would be 1.2741 if it was an amortized loan based on
Yeah.
these.
And I have to jump in here because so many of these numbers people, they compare numbers and they
Mm-hmm.
always miss. They skip right over because they don't even realize it matters. The assumptions behind the numbers,
Yep.
right? if the numbers really spoke for themselves, they wouldn't require any explaining, but the numbers don't speak for themselves. And even more insidious, the assumptions behind the numbers that you don't realize you're making. So scroll back up to the top for a second. I want to reiterate this, right? So a lot of people would look at this and look on the current mortgage to the left, annual interest rate 4%, and look
Right.
at the HELOC, annual interest rate 7.5%. Say,
Yep.
see, you're paying almost twice as much in
Yep.
interest in the HELOC, right? And by the way, people do this with lots of different things. It's not just
Mm-hmm.
this particular use case. I see this all
Yep.
the time. Okay. So always be suspicious when people throw out numbers because the assumptions behind the numbers are what matter. Okay.
Absolutely.
So now what you've done is you said, no, I'm now going to give you an apples to apples comparison.
Mm-hmm.
True apples to apples comparison would be okay, 4% on the amortized mortgage and then scroll back down. And what that
Yep.
would actually equate to in terms of the first lien HELOC would be
Oh,
not 7.5%, but 1.27%. That number there, right?
yep.
Because now we're making the right assumption and we have an apples to apples comparison, right? It's
Correct.
really important when you're looking at numbers that you understand the assumptions behind those numbers because that's where the real thinking
Yeah.
goes into it. And then good
Correct.
numbers
Correct.
are a result of good assumptions and good thinking, not the other way around. The numbers themselves tell you nothing. You
Yep.
have to know making the right assumptions to pick out the right numbers because not all the numbers are relevant, not all of them are accurate, right? And then
Right.
knowing how to interpret those numbers too.
Right. Yeah, exactly. So even in the appointments, what I'm very careful on is as I let people know, I don't believe that you are going to stick to this. I tell them right away, right? And so they're like, "Oh my goodness, you don't trust me?" I'm like, "No, it's not possible for you to do this every single month. Life happens, right? So I know that something is going to happen. Here's a good rule of thumb to keep. You realize that your income is 7,200, your expenses is 3,078. Well, that creates a ratio, right? So if we took 3,078 and we divided it by 7,200, we get that you are operating at a 42.75% ratio of expenses versus your income. As you grow in income, you can continue operating at a 42.75%. Uh, you can continue operating at that rate. There's little funny things with Zoom. So you can continue operating at that same rate. If you're making $10,000 now, you can up your expenses a little bit, right? If you're making 11,000, then hey, live your life. I'm not here to tell you not to live a cool life and enjoy it. Be responsible and just keep the same rate of expenses. Now, of course, at some point, you're just spending dumb money, right? So, when you're making $60,000 a month or something crazy like that, you should not be in the habit of saying, "Oh, I'm making 60,000. I need to spend personal expenses." Your personal expenses should not be 42% of 60,000. That's ridiculous at that point, right? Now your business expenses that may be different, but you just want to make sure that you kind of keep in line with that. And what's so beautiful about it is oftentimes the other part, because people are so interest rate driven, they say, "Oh gosh, but it's an adjustable interest rate. It's a variable. It changes." Okay, all right, it changes. You're right. It does change. Let's see if we went to 18%, what would happen? 18%, you're still on track for paying the house off in 10.75 years, right? Now, I've jumped this interest rate up to a place that it's probably never going to reach. But what about the places that you think it could reach? Do you think it could reach 11? Okay, you think it could reach 11. You still be done paying off the house in 6.67 years. So is there a cushion there? Yes, because the interest rate is not as important as you believe it to be. Now, when is the interest rate important? Well, 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 well. What if we turn this into 7.5%? Let's make them even, since that is something that comes up all the time. What would be the difference then? What would be the difference then? This tells the story. Interest rate is far more important in an amortized loan because it prioritizes interest first. Interest is less important in a simple loan that is revolving because it prioritizes the principal first and it calculates the interest based on that. So now you see 104.47% interest when they're locked at the same rate, or at 7.5 and 7.5. This is very eye-opening for people because they never thought about it like this. They've only thought, okay, interest rate, interest rate, interest rate. And the reason why you think that is because of the loan you're in, not because that's actually what's most important. Right. So, and it's thrilling to watch, when you start going down to the numbers and all that kind of stuff. I always do this metric of the interest payment on the first month and the interest payment on the 24th month. Is usually somewhere between $50 or $60 of a difference. And then you start to look at the HELOC and it's setting an interest payment. Now, and here's the funny part. I want to go back to this too. You notice the interest payment is lower on the HELOC than the interest payment on the mortgage, right? The reason why is because, well, now you're in a simple interest loan and it's focused only on principal, whereas before in the mortgage, once again, remember 80% going towards that place. So when you even out the interest rate, it's still not even in a mortgage and a HELOC simply because the HELOC is not prioritizing the interest first. So the interest payment will be more if they had equal interest rates. Something a lot of people don't talk about. They don't notice that. And this is showing a loan that has been in place for 8 years already. So I'm comparing something that's older to something that's new, to them jumping in a HELOC right now, right?
Right.
This, when you start looking at these differences, 34,000 in the first year versus $5,000 in the first year, when you start really taking a look at where a person would be, even when the loan is paid off. All right. So it's paid off in month 70. Well, if you were in the HELOC, you would have paid off 35,312 in comparison to
In the
220.
mortgage. Yeah, in the
Yeah,
mortgage
if
you
you're
will
in the
pay.
mortgage, you would have paid off 35,312 if it had the same interest rate with these situations, right? Now, of course, we can take it back to where the client interest rate actually is for a more realistic view. Now, and I'm not going to tell you, there are some clients I run into with some 6.6 interest rates lately on a mortgage. Disgusting. It's horrible, right? Horrid. But when you look at them now, even if we were to take this approach of saying, all right, well, what about in year one, we've changed the interest rate back to 4%. It would be $7,816 that's paid off versus 34 grand, right? Now, I don't know why financial advisors don't talk about this tool, but I want to ask a question. How much is a contribution, max contribution on a 401k?
Was it 15% of your income?
Yeah. For some, they're maxing out at about 26,000 a year, right? So you think about this and you say, huh, they could be maxing out in contribution without any guarantee as to how much it's going to generate. And you could actually be making sure that you paid your house off in a shorter period of time. Now, once you've done that, you can create your own, if you wanted to do retirement in safe vehicles, you can create your own. You can say, all right, well, What if I borrowed 100,000? Well, now I know 100,000 takes me 2.25 years to pay off. Would 100,000 be really valuable inside of an insurance policy? Would it be really valuable even inside of a fixed index annuity or a fixed annuity? Yes, because it's a lump sum of money. It's a lump sum of money. So a lot of people are starting to front load their policies this way and then drop down on premium in the remaining years on their policies because now they can see, okay, this is a good place to sit money. It grows tax free. Don't have to worry about having to deal with loss or anything like that if you're talking about a policy or even a fixed index annuity. So you have some different options available to you that you can grow money without risking money, right?
Yep. And this is what velocity banking and infinite banking both do.
Yep.
We have to get away from this return on investment metric.
Oh yeah,
Okay. Return
absolutely.
on investment means I'm going to take my money and park it somewhere where it's static in somebody else's jail where I get no liquidity, I have no access
Right.
to it, I can't touch it, can't look at
Mm-hmm.
it, don't want to touch it, right? As opposed to what it really should be about, according to Robert Kiyosaki, not return on investment, cash flow. It's all about cash flow.
Yeah.
Where is my money flowing? Is money flowing to me or is money flowing away from me? And how efficient is my cash flow management process?
Yeah.
Both velocity banking and infinite banking work to dramatically improve your cash flow efficiency
Efficient.
without making more money, without magically the market goes up 45%. None of that. It's just
Mm-hmm.
taking what you already have and maximizing the use of that money by putting it in motion. That's
Mm-hmm.
why I like the phrase velocity banking, creating that velocity of money,
Yeah. Put
right?
it
So
put
your
it in
money is
motion.
in motion and every dollar can now do multiple things for you, right?
Absolutely.
It's working for you in your house, by building equity in your house and benefiting from the capital appreciation and paying down debt, right?
Mm-hmm.
And that's working for you potentially somewhere else as well when you draw from that home equity to do something with it, deploy it, right?
Absolutely.
Deploy
Absolutely. Yeah, there's just so many ways to make this valuable for you because it actually creates a recycling effect.
it. Exactly.
So that when you use the money, now the money can keep the house going. Like for instance, some people say, oh, okay, well, what if I lost my job? Right? Well, we've already discussed that it can hold you over until you get your next job. But well, what if you became disabled? Well, if you had a policy in place, like a disability insurance policy or like a life insurance policy, couldn't it fix that? A disability insurance policy can start triggering and pay back to the HELOC to keep it to keep paying it even though you're not working, right? We do these things for security, right? And that's the beautiful part of this process is that what you've normally done or what the industry of finances has done is it's made you view this thing called securities as something that should involve risk, which is kind of strange to me. Like when we talk about securities, I'm like, I, okay, I get that it's because of the Secure Act. I'm not stupid. I understand that. But still, why do you call it securities? The word secure means something. It means something. It should not involve risk. Nobody feels secure with risk. you
Yep.
know, so it's like, put strategies in place to actually make security possible. And if you want to play a little bit, do that. I don't, you know,
Yeah, and I love that word you use, recycling, because both velocity banking with a first lien HELOC and infinite banking with a
infinite
specially designed
are
whole life
recycling
policy,
tools.
yeah, they allows you to use the same dollar over and over and
Mm-hmm.
over and over and over again. So if you want to make $100,000 investment by using infinite banking and velocity banking, some combination of the two maybe,
Yep.
you can use that 100,000 and have it be replenished, right? And use it
Mm-hmm.
again and then use it again through this constant
Yeah.
cycle of borrowing out the money, strategically paying it back,
Yep.
borrowing it out, deploying it, paying it back, right? And so now instead of throwing money away or putting money into a single use vehicle, parking it when you deploy it, you're not throwing money away, you're recycling it.
You're recycling.
So instead of seeking after return on investment, right? Because the reason why people shoot for these high risk investments is because when you're looking at return on investment, each dollar works for you once. That's it. And so there's a ton of pressure on that dollar to produce. So
Yes,
as a
absolutely.
result, you're trying to squeeze out a higher return because you need it.
Absolutely.
What if you
Absolutely.
could instead take that same dollar and get it to work for you once, twice,
Yep.
3 times, 4 times? Now you'll find you no longer feel this urge to take on all this risk and search for the highest rate of return, right? Because you
Absolutely.
have cash flow, right? And so I would much rather have a modest, safe level of return and much more optimized cash flow. And I'm going to end up in a much better situation with a lot less risk. Peter Nelson always talks about the 3 lies of Wall Street. One of them is higher the risk, higher the reward.
That's a terrible line.
That is the opposite of the case. I think you kind of
That's one of the
explained it. You're
worst
like, wait a
lines
minute,
there is.
let's just unpack that. What does high risk mean? High likelihood that you will lose.
Yeah, that's all it
How does
means.
that translate into higher reward? Right?
It does not.
I was thinking about this. I was thinking about this. We were talking about fiduciaries and all this stuff. Right? Like, think about all the paperwork that you fill out when I don't know, you want to invest or something. There's always some paperwork involved, right? That you sign. What do you think that paperwork is for? Is that paperwork to protect you, the consumer, or is it to protect the financial institution
Right.
who's selling you this product so that when the market crashes, you can't sue them because you signed the paperwork saying, yep, I understand this has risk. I understand all this. I'm signing my life away. I could lose everything, blah, blah, blah. Sign it, in triplicate, in blood, right? So that you cannot sue them. So that paperwork, all that legalese is not to help you understand what you're getting into,
Right.
right? It's not to protect you. It's to protect that financial institution.
Yeah.
I had a guy I
And
was talking to, and he had sort of gone through this process with a financial advisor and ended up deciding not to work with him. And then I was talking with him. He was very nice and explained to me why, hey, why that didn't work out, and I don't want you to waste your time. So
right.
let's understand this. And I was like, yeah, great. I don't want to waste time either. So sure, if you want to vet me and get rid of me, let's do it quickly, right?
Let's go.
And one of the things he asked me is, oh, can you send me like your standard legal agreement that you do with your clients? And I was like, I don't have one.
Oh,
I
yeah.
don't have one. What? And
Yeah.
and I realized that's not a negative, that's a positive.
Right.
I need all this legalese,
Right.
okay? Because it's a very different kind of relationship I have
Protect
with
myself.
clients. You're not giving me your money.
Right.
I'm not licensed to lose you any money.
Right.
So why do you need to sign your life away via all this
That's a
legalese?
good point.
Right? I don't
I
have to
never
put
thought about
together
that. I never thought about it like that. That's a
a
good
ton of
point.
paperwork and a legal working arrangement
Yeah.
because you're not taking on any risk. Now, there is some paperwork between you and, say, the insurance company where you take out a whole life policy, certainly.
Right.
But pop quiz. When my clients are ready to sign up for the policy, they're about to sign the paperwork. I say, okay, pop quiz, D'Andre. This is a contract you're signing.
Right.
What are your obligations under this contract?
To pay.
Nothing. 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 It's a completely unilateral contract.
Right.
You are not signing up for anything. The
Right.
insurance company is the one with all the obligations.
Yeah.
You are
The
transferring
insurance company
risk
has far more risk. Far
away
more.
from yourself to the insurance company because that's the service that insurance companies provide. They absorb the risk. You're not even signing up to pay a premium. Now, obviously, I'd recommend you pay a premium. There's a reason why we structured the policy the way we did, but there's no liability to you. If you don't
Right.
pay a premium, no one comes to repossess your house,
That's true.
right? So it's a totally unilateral contract. And I think attorneys oftentimes are good prospects for me because they understand the importance of contractual language.
Mm.
When you read through a whole life insurance contract, it's a throwback to back in the old days when we were actually allowed to own things and the financial system actually was somewhat sound, right?
Right. Right.
This is a contract that actually favors the policyholder. The insurance company is actually providing a service. And
Absolutely.
because we work with mutual companies, when you sign that contract, you are becoming a business partner with that company. You are not a profit center to them. You share in the profits, right? So you may remember in my financial malpractice series, this financial advisor is trying to criticize insurance companies because they're profitable,
Oh
right?
yeah,
And he's basically saying it's a win-lose proposition where if you take out a policy with an insurance company, they profit by stealing from you and you lose. And it's like, it's exactly the opposite. The more profitable they are, the more the dividend you get,
the
right?
more dividends you
You
get.
get dividend from that company. And why would you want to work with an unprofitable company, right? And it gets
That's
back to the scarcity
yeah.
mentality that wealth is a zero-sum game.
Mm-hmm.
But the only way someone can make money off of you is by extracting it from you, right?
Right.
Like, no,
Right.
wealth can be created.
Yeah.
We are value creators. Um, the society today is way more wealthy than it was 200 years ago, right? Wealth has been
Absolutely.
created. There is more wealth out
Absolutely.
there. And so when you create value, I think guys who think that way are basically engaging in projection because what they're saying is I'm a
Yeah.
parasite. I extract value from people. And so when I see
Mm.
any other economic relationship, I just assume it must be parasitic because
Mm.
that's the sort of relationship I have.
Back to the biology. Back to the
Yeah,
biology.
exactly.
I see you over here.
Yeah, yeah. So, and there was something else I was going to say. I lost my train of thought on that. But yeah, I mean, this is such a great,
Yeah.
phenomenal tool. And when you go through this with your clients, do you get the same? So when I go through my clients with infinite banking and they really start to get it,
Mm-hmm.
do you get the same sort of question I typically get, which is DeAndre,
Why
why
isn't
isn't everyone doing
why
this?
isn't everyone doing it? Yeah. It's funny. It's funny you mentioned that because I used to actually go through the whole PowerPoint presentation, right, for this product. And towards the end of the PowerPoint presentation, there's a question that's sort of like that, like, why haven't I heard about this?
Mm.
Right. And so I get that very often. And oftentimes people say, I should have met you 25 years ago. I don't know why, but 25 seems to be the most common number that I hear for some reason. So I hear that on infinite banking consults, and I also hear that on the HELOC consults. And I said, well, I don't know how much of good I would do you. I was about 11 at the time. I was about 11 at the time, so I wouldn't have helped you too much, to be frank with
Well,
you.
and the other thing I wanted to point out, the first lien HELOC is a lot more than just a first lien HELOC. So this is because people hear HELOC and they're like, oh yeah, I have a HELOC, right?
Mm-hmm.
Just like when I say infinite banking, oh yeah, I know what whole life is.
Yeah, no,
No, this is so much more than that,
they
right?
don't know.
The concept, it's
Yeah,
velocity banking. So yeah, I'm sure you know what a HELOC is. Okay.
right.
This particular product is not just a HELOC. It's a HELOC that replaces your mortgage and any existing home equity loans that you have,
Mm-hmm.
and it automates the process of velocity banking. So what
Yep,
happens is you are given, this is a very special product. You are given a checking account with an automated bidirectional sweep.
yep,
So you deposit money into your checking account, your paycheck gets direct deposited in, or you deposit money, it gets automatically applied to your HELOC balance. Okay. When you withdraw money, same thing, it gets automatically pulled from your HELOC balance. What that means is money that would have been sitting idle in your checking account, which we all have some, is no
yep,
longer idle. It's now working for you inside your home.
yep,
But yeah, to get back to your point about
yeah,
with both infinite banking and velocity banking, the lack of comprehension, right? It's just, yeah, I have a HELOC. Yeah, I know what a HELOC is.
yeah,
And they
all day.
completely whiff on this much broader concept. I've had multiple people, where I explain this to them, and then a few months later they come back and
Mhm.
say, "Hey, I'm doing this now. I got a HELOC." I'm like, no, no, that's a second position HELOC
That's the
on your
second.
mortgage, and you're
It
not,
happens all the time. It's
and
like,
you're not running your cash flow through it. You're not getting any of
uh,
these benefits. You just took on another debt instrument, which could be
yeah,
good. I
yeah.
mean, um, yeah.
That's
Something else I
yeah.
was gonna say.
It's funny you mention that because what I get often is mostly the fear of running money through the HELOC. Oh gosh, but what happens if? Oh, but what happens if? And then somehow people just have amnesia with what just happened in California. Nobody fears when a bank fails anymore. banks are failing all over North America, and we're just like, oh yeah, we'll still continue banking with them. No, like you have to take things like this seriously and start to wonder, okay, well, why is this? Because really, the reality is even the FDIC insured standpoint isn't fully sound as we would want it to be. And then when you look at what, at least in the HELOC, at the very least, you could say the collateral is the house. So I know that this money is going towards something that opens up something, right? That opens up a certain amount of space. Whereas, you don't typically have the type of money that you would have in the value of your house. You don't typically walk around with that amount of money in your bank account. Why? Because you can't insure it. You can't insure over 250,000 unless the house is owned by a trust or something like that, or the bank account is owned by a trust because those numbers have gone up a little bit. But
Or if you're doing the right thing and doing the infinite banking concept,
or
your
if you're
cash
doing the right
value
thing and doing the infinite banking thing,
in a whole
right?
life policy.
Right,
Yeah.
right.
So in my 30-minute video where the title is "How much money do you have in the bank?" I talk about this. How look,
Mm,
um, when you make a deposit into a bank account, let's say you make a $10,000 deposit into your bank account. How much money do you have in the bank? How much of that money is yours?
you
Zero.
zero, actually. A
Zero.
lot of people don't know that. I was about to say
You
zero,
just
but I don't want to
made
hurt nobody's
you
feelings.
just made an unsecured loan to the bank, and it's now the bank's money
Yeah,
legally.
you're a private
Legally.
lender. You're a
So
private lender.
people get this warm and fuzzy feeling about FDIC insurance. I'm like, wait a minute. Why is insurance even necessary?
Mm,
If there were no risk of loss, no insurance policy would be necessary, right? I don't understand why people like the idea of FDIC insurance. I'm like, that's the whole point. It
yeah.
needs to be insured because it's at risk.
Because it's fractional banking and they're lending out $10 to every one that they receive from your account. So they don't actually have the money in your account. There's a signal that comes in when you ask for money, but there's still limits to how much you can actually take out at one time, which is what we saw in California.
Right. So whose money is it really? Right. Um, why does everything
Yeah.
take 2 business days? Why does everything in the banking system take 2 business days? It's not a technology issue. It should be instant. The
It's,
reason is because they don't have your money. When you come to get supposedly your money, they don't have it. They've loaned it out. So
it's,
what they have to do is go and scare it up in the repo market overnight. Hence why everything takes 2 business days. And same thing if you move large amounts of money around, it's like, oh, wait a minute, we got to put a hold on this and for your
yep, yep.
safety. And you must be some kind of terrorist because you're trying to move large amounts of money around, right? Whereas a policy loan from a whole life policy, it's a contractually guaranteed right.
Yeah, they don't care
They
about.
can't say no to you. It's
Yeah,
contractually guaranteed. You have contractual
yeah.
guarantees over the cash value in a whole life policy. It's actually yours by contract,
You
right?
you mean you don't have to answer to somebody if it goes above 10,000? The IRS doesn't come get you?
No, no.
What?
You don't even have to report it.
Huh?
It's a totally private asset.
No.
Yeah, yeah. That's why rich people love it. Yeah. Um, there's so much more we could get into this with this, but I think this just emphasizes what you and I talk a lot about, which is it's all about cash flow.
Cash flow. Absolutely.
And if you want to invest your money somewhere and speculate and hope for a return on investment, okay, this actually increases your ability to do that, and it increases your ability to do that safely, right?
Yes. Yes.
Because because as an example, if you borrow against whole life and make an investment and that investment goes down, well, you still have the money in whole life and it's still
Still have the
earning,
money your whole
right?
life. Yeah.
So it at least cuts your losses, if not eliminates them. Same thing with the HELOC. You can, if you lose that money, well, it'll be quickly recycled back in, right? So as a
Yeah.
result, you can replenish it relatively quickly.
Yeah. And I mean, like you were saying about speculation, oftentimes I tell people the only speculation I view as safe is the one that doesn't have loss attached to it. So, if you don't have risk attached to it, then I'm not that mad at a person speculating, right? Because it hurts to speculate and lose.
Mhm.
But speculating and, having something fixed, like, they got MIGAs out there, they got all types of stuff right now that could gain money. It's valuable on lump sums of money. I did an illustration, and I was telling Peter about it, where I did an illustration with an Athene fixed index annuity. And what basically I did was have the client pay their house down quite a bit, and then they wanted to say, hey, well, what do I do with this extra money that's available now? So they had over
Just
$500,000.
stop there for a second. Like,
Right?
think about that guy. Think about that, guys, right?
What do I
What
do with this
what
extra money?
DeAndre did was, without charging him anything, without changing anything, just by putting him this more efficient cash flow vehicle, all of a sudden they have all this additional money available.
Yep,
Like, if you come work with me, I'll find, or DeAndre, with what we're doing, we'll find you another 100, $200,000
we'll
of
find you.
cash that you didn't realize you had.
We'll, you
Where am
are
I going to get the money to do this? Well,
just.
I'll show you.
It's so funny. So it's so funny you bring that up. I'm going to get back to the other illustration, but
Yeah, sorry, I derailed you.
one
Apologies.
of the first, one of my earlier on appointments with the HELOC that showed me the power of it, and I was just all the way in from this moment, was a client who had a $1.1 million home, and then it was on track for costing him 1.26 in interest. And by the time we put his figures together, he was actually only going to pay about $42,000 of interest in the HELOC because he wasn't spending money. He was just working like a dog, right? Making a ton of money, not spending nothing. And when he first approached me and we had a conversation about infinite banking, he was like, "Where am I going to get the 100,000 per year? Like, I don't know, man. 100,000 per, that's steep, man." And I said, "Yeah, you're right." And then we looked, and once we ran the calculations, he looked up and he said, "Oh, so I'm saving 1.215." So technically, me moving to the HELOC pays for the policy. If I'm looking at it from a total capacity. And I was like, yes, if you want to say it that way. He was like, no, that's what it's saying. So it created, and this is not talking about how much the policy was going to grow by. This is just talking about the availability of the money. That's crazy. I was like, whoa. And he was going to be done paying for the house in 6 years. He's on track for paying it off in 6 years with that strategy in place. Right. He's not looking at the market anymore. He had money in the market. One of his family members was a CFP, and he was like, I don't understand how they don't see the benefit of this. Like, he said, I ran it past him, and he just like, no, there's no way it does that, right? But he started seeing the HELOC working, and he said, I trust you now because I got
You
money
gave
back.
him, yeah, you
I
gave him
got money
immediate,
back.
concrete, tangible results,
Yeah,
right? You gave him
yeah.
something tangible, and there's
I
no hypothetical here.
ain't no
Not like,
hypothetical.
well, if the S&P 500 goes up at
Nope,
this
wasn't
amount.
that. Wasn't that.
So, and I think you're right, because you can do velocity banking and infinite banking and put your money into the S&P 500. You could absolutely do
You could
both,
do
no
all of
question
it if you
about it.
wanted to.
But I think, and we've increased your capacity to do that with
Yeah,
lower risk. But I think you're right, just that the more people do these alternate strategies, they look at putting money in the market and say, well, that's taking on a lot of risk that I don't need to, because I don't
right,
need to take on the risk anymore. And it's not giving me any cash flow or any liquidity. I can't
right,
really borrow against it on favorable terms. Like, what?
right.
Why would I do that? That's parking my
Exactly.
money in jail. I want my money in motion.
Exactly. And I think that's partially the reason why when you do this method or when you do infinite banking, you get so much pushback from those who manage money most of the time because they realize that, uh-oh, if the client realizes that they can control their destiny and they don't need an expert to do it, oh, I'm in trouble. They're gonna get rid of me. And it's not that the client has to get rid of you. Because if the client just wants to play the market, I don't talk the client out of wanting to play the market. If that's what they want to do, they have that itch, hey, do your thing.
Yep.
You have more availability to do it now than you ever had before. You have far more safety functions in place that if you lost, your life isn't over.
What
Like,
people really need to understand about the strategies we're talking about is I am not telling you to do anything differently. I'm not telling you to change your investment strategy. I'm not telling you to
nope,
spend less and save more, right?
nope,
I'm just saying, let me optimize your cash flow because no one's looking at your cash flow right now. They use this word, and I hate this word. They use this word portfolio to get you myopically focused on just the investment strategy as if that's the only part of your financial picture that matters.
right,
And just to focus on the final resting place of your money after it's gone through my cash flow management strategy, which really means just a checking account, a dumb checking
right,
account, no balance, no benefits, right? Gives
right,
Wells Fargo benefits, but not you, right?
right.
And so I'm just looking at the final resting place of my money, and I'm just looking at the 10% of my income that I can actually
Yep,
invest,
yep,
ignoring the 90% of everything else that's just leaving your personal economy personally,
absolutely.
ignoring this whole cash flow question. What we do is so common sense. When you're looking at your financial
Yeah,
situation and you're trying to figure and you're talking with your wife, like, how are we doing?
yeah.
You don't ask, hey honey, what return on investment do we get this month? No, you ask, how much money do I have coming in
That's
and
so
how
funny.
much money do I have going out?
I'm trying to picture
That's
that in my head too. Like a family just having family dinner, like, hey, what's the return on investment in
and
our
she
family?
goes, 6.2%, right? But if you ask someone how much money do you make, they'll know the
Don't
answer to
know.
that question
Don't
because
know.
that and if they get a promotion and now they're making 180,000 instead of
They know.
150,000,
They know.
they'll know all about that.
Yep.
That's an immediate impact to their lifestyle. When you
Absolutely.
park your money in Wall Street's jail, it's a detriment to your lifestyle, right? It's taking money away from you, right?
Yeah. Yeah.
So it's the four rules of financial institutions. Rule one, give us your money. Rule two, give it to us on an ongoing, systematic basis.
Mm.
Rule three, let us keep it for as long as possible.
All is
And
possible.
rule four, if and when we give it back to you, we're going to give it back to you as slowly as possible.
Yep.
You and I do, D'Andre, is we help people reverse that flow.
Yep.
Okay.
Absolutely. Absolutely. Yeah. I mean, all of that is so true. I remember being so confused by the market when I was a kid. I was like, okay, so hold on. So
First of all, it's not a market,
if
but
you
go
lose
ahead.
money, that's when you're supposed to put all the money in there after you lost. I was, I was as a kid, I was just like, and then you can't take it out until you're 59 and a half. I just don't understand this. Like, if I was losing, I want to move while I'm losing before I lose it all.
Cui bono? There's always the question asked. Cui bono? Cui bono? Who benefits? Who is
Right.
benefiting
Who
from this
benefits?
relationship? Not you, the financial institutions you're giving your money to. Okay.
Absolutely.
And
Absolutely.
these fiduciaries who say, I'm acting in your best interest, I'm acting in your best interest. Since when is it in the client's best interest to lose money? Because if you give your money to a fiduciary, it's well within the realm of possibility that you will lose money, and you probably will lose money from time to time. Is he going to make you whole? Like if you're saying you're acting in your best, he's acting in your best interest, then what should happen is if your investments go down, he's, sorry, man. Here, let me give you your money back. I'll make you whole and I'll make up for the lost
That
opportunity.
would be crazy.
Then I might believe them,
Then that's best
right?
interest. Yeah. Then that's best interest. It's funny you say that because I've always asked that similar question. How is a fiduciary acting in a person's best interest if they don't guarantee anything?
Right. Right. What it is again, gets back to
But
what I said before. The whole fiduciary rule is set up to protect Wall Street and the financial institutions. They set up this legal framework such that if I dot the I's and cross the T's that are laid out for me, now I cannot be sued and I cannot be held liable when you lose all your money. Right. The whole fiduciary system and the rules and regulations are set up to protect the financial institutions from liability when they lose your money. Right. It's not set up to protect the consumer. It's set up to protect Wall Street. And to me, this is obvious. I mean, this isn't
Yeah,
hard to see, right? It's not hard to see at all.
yeah. I mean, we were talking about that article where I asked you if it was financial malpractice because of the
Yeah.
the old guy. I don't. He looks in the picture. He looks like he's every bit of in his late 80s
Mm.
and lost 50 million with J.P. Morgan, and now his fortune is down to 1.5 million, and he's trying to sue them. And the advisor's response is he knew the risk.
Yeah. That's why they
That's
make you
the
sign all
advisor's
that paperwork.
response. He knew
You're
the
not
risk.
going to win that lawsuit. You won't win it. That's why they make you sign all that paperwork, right? We didn't make anyone sign paperwork. We're putting this up on YouTube. This is just common sense, folks.
It's common
It's common
sense.
sense. So D'Andre, this was great. I know we'll go through this again. I mean, we got so many subjects to talk about. Thank you so
Yeah.
much for introducing us to the First Lien HELOC solution. D'Andre and I are both ambassadors for the program. We're both believers in the program. It's not for everyone, I'll be honest. There are some caveats. If you talk to us, we'll tell you, and so will the First Lien HELOC people, because we don't do it ourselves. They'll look
Absolutely.
at you and your numbers, and they'll tell you whether you're a good fit or not. You may not be.
Well,
There
hold
are,
on. They'll turn you away. They're supposed to want all the loans. What?
yeah, I know. It's
What's
funny.
going on?
It's funny, D'Andre, when you want to go and buy mutual funds, there's no qualification process. They'll
No,
take all of your money you want to give them. You
no,
could lever up irresponsibly and throw all your money in the market. They'll take all of it.
no.
And then when the market crashes, you take the losses.
Yeah.
If you want a whole life policy,
It's suitability out the wazoo.
you've got to qualify, and they will not give you an unlimited amount.
Yeah.
Try getting any of these shenanigans past the underwriters. You will not get very far. They will not allow it.
Nah.
They won't let you be financially responsible. If you're not healthy, they won't let you through the front door, because this is a high quality product
Yeah.
and you have to qualify. The product is awesome. The question is, are you good enough to take the product? That's the
Mm,
question, right? That's why you got to go through
I
underwriting,
love it. I
and they
love
will limit you. That's why case design is so important, because we have to optimize the limited amount of insurability that you have. All of us have a limited amount of insurability. We can't just take out a whole life policy whenever we want. This is something I'm getting on my soapbox. I get people to secure their insurability with
it.
convertible term, because people act like this is like a mutual fund where I can just buy as much as I want whenever I want, and
Yep.
I'll think about it. It's like, no, 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 no.
Yeah.
You are very limited in your ability to buy this solid gold stuff. So you better secure that right as soon as
Yeah.
possible, right?
Yeah. They
Um,
think they're doing the insurance company a favor, and I'm like, I don't know how you could do that when reading an illustration. Like you could have put in $20,000 with a death benefit of like 500,000. How is that you doing them a favor? You know, it's crazy. It's crazy. So it's important for people to learn how to comprehend things, and I think that's always going to be the battle, right?
yeah, yeah,
Is to help people to understand that you can understand these concepts. You can understand a policy. You can understand all these things, and that I am just I'm just a vessel, sort of speak, to help you to get to that point of understanding it. But by no means am I smarter than you. I'm not that much more brilliant than you are. Where he's gonna get it, but I can never get it. It's just out of my realm. You have to get out of that mentality that the other person who's on the other side is just a genius. No, the reason why you think there's a genius is because there's no good answer for whatever they're trying to teach you. And that's the reality when you're dealing with the market at large. Most of them don't have good answers. They can't force money to perform well and negate loss completely. They can't, because most of them don't even follow the same rules as the number one investor.
yeah.
I haven't found too many CFPs that actually agree with Warren Buffett.
And what's your option strategy? That would be my question. Like, look, if you're going to take on risk, then there needs to be a risk mitigation strategy.
Yeah.
And I'm not securities licensed, but I'm here to tell you it's a very basic thing. When good investors put their money at risk in the market, they buy options.
Yep.
They're buying put options. They're
Yep.
selling covered calls, right?
Stop and loss.
These are
Stop
just
loss.
basic strategies that should be in place. If you're a real estate investor, are you going to buy a home and then not buy homeowners insurance? So look, if you're going
Yes.
to invest your money in the market, you need an insurance policy. Okay. What happens when the market crashes? Oh, just wait, it'll come back. No, that's not what smart investors do. Okay. If you don't have some kind of rudimentary option strategy, in my opinion, you shouldn't be in the market. All
Yeah.
of the good investors use options, and I'm not securities
Yeah.
licensed. I know this, and it's not that challenging.
Yeah.
Options used properly actually reduce your risk level. Okay.
Absolutely. Absolutely.
It's not hard, but of course that's not what they do. It's just let's put you in mutual funds, and we have no risk mitigation strategy. Why? Because we, the financial institution, are not taking on any of the risk. So why would we take steps to mitigate that risk? You, the customer, are
Absolutely.
taking all the risk. So
Absolutely.
we're not buying options. Why would we do that?
Absolutely.
We're gonna make you think that options are this big, scary, risky thing,
Yeah.
when really they're pretty simple. And
Yeah.
used properly, they reduce risk. They don't increase
Hmm.
risk. So
Absolutely.
that was a big tangent. But D'Andre, you want to close us off with some final thoughts on the first lien HELOC and velocity banking?
Oh man. So first and foremost, don't try it on your own. Book a call with an advisor. Book a call with an advisor. I can't tell you how many times I've had people who come through my website and send me a message. Hey, I applied for a HELOC 3 months ago. I want to know what's the status. I don't know. I don't work there, right? But it's important because you're embarking on something new. Make sure that you have as much knowledge about it as possible because we want to educate you. We don't want to simply make you feel like they have all the answers and then I just follow their lead like a zombie. No, we want you to learn and be efficient because the first position HELOC is one of the most efficient tools that there is because it takes on the largest debt that you have, the one that is, the boogeyman in the closet. And then you start to learn that you can even take on the other large debts. Maybe it's student loans. Maybe it's this. Maybe it's that. You can see the forest from the trees when you get involved with this loan and you have a good budget. So number one, just have a good budget. Number two, make sure that you book a call with myself or Logan. It doesn't matter. I don't care which one. But book a call with somebody who actually understands math, who understands banking, who understands interest. Because if you don't, you'll be sold a dream or you'll be sold that, hey, this isn't for you because I make more money on a mortgage, right? And that's something that a lot of you don't understand. What we're marketing, what we're trying to help you understand is that whether it be infinite banking or whether it be a first position HELOC, these are not huge commission centers. Let me repeat. A mortgage loan officer makes far more off of a 30-year mortgage that's amortized than they do off of a first position HELOC, right? Which is why sometimes they want at least a minimum draw because they want to make it worth their while so they can get at least $500, right? They're trying to do the right thing by you, right? Same thing with infinite banking. The agent is trying to do the right thing by you when he's structuring a policy that is low death benefit, high cash, and changing your ratios. They're taking commission right out of their pockets. How many of your advisors are willing to put their money where their mouth is and take away from their own commission to make sure your goals come true? Not too many. You'll find that out in this industry. Not too many will tell you the truth if it costs them money. So follow the money in every sense, whether it be your house, whether it be your investments, whether it be wherever you put your money, you will understand that it's far better to follow what they're doing, how to understand their structures, fees, so on and so forth, and you'll get a better idea of why me and Logan are talking about financial malpractice and different things like that, because it is borderline financial malpractice for sure in many cases that we see.
Okay. D'Andre Clayton with
All
a
right.
first lien HELOC and Velocity Banking Strategy. Thanks so much for your time, man. It's great to see you again. I'm sure we'll do this again soon.
Thank you, Logan. Always, man. We enjoy it.
All right.